Stop what you're doing. Immediately. I don't care if you're in the middle of a Zoom meeting. Mute yourself. Your boss will survive. I don't care if you're parallel parking. Put the car in park. The spot will still be there in 8 minutes. This is more urgent than whatever you think is important right now. Are we locked in? Good. Oh, and one more thing. If you own copper, mining stocks, futures contracts, physical cathodes in a warehouse somewhere, do not check the price until you finish this video, because what I'm about to show you will either confirm you're sitting on a gold mine or it will make you realize you've been focused on the wrong metals this entire time. Ladies and gentlemen, this is Price Discovery Desk. It is February 2nd, 2026, and I'm about to expose something that Wall Street has been hiding in plain sight while everyone was distracted watching gold and silver. Copper just broke through $5.40 per pound. That doesn't sound exciting until you realize what it means. We are 11% away from the all-time high. We are entering a supply crisis that makes the silver squeeze look like a warm-up act. And the smart money, the people who never tell you what they're doing until after they've already done it, has been quietly accumulating copper for the last 6 months. Let me back up for anyone who thinks copper is boring. 3 months ago, we talked about how copper inventories on the London Metal Exchange were dropping. We talked about how this was notable but not alarming. Industrial drawdowns happen. Seasonal patterns exist. Nothing catastrophic. 6 weeks ago, we talked about how those inventories had fallen by another 23%. We talked about how China was importing record amounts. We talked about how this was starting to look less like seasonal demand and more like strategic stockpiling. And I told you to watch the 3-month forward curve. I told you that if backwardation intensified, if near-term prices started trading higher than future prices, it would signal immediate shortage. It would mean the market was screaming for metal right now, not next quarter. Well, the curve didn't just backwardize, it inverted violently. As of yesterday, spot copper is trading at $5.43 per pound, while the 3-month contract is at $5.31. That is a 12-cent backwardation. That is a 2.2% penalty for waiting 90 days to take delivery. In a normal market, you get paid to wait. Storage is free, time value is positive. But this market is not normal. This market is telling you that copper today is worth more than copper in 3 months. And when a market does that, it means one thing. There is not enough metal available right now to meet demand. Let me show you the numbers because numbers don't lie. The London Metal Exchange reported copper inventories of 87,450 tons as of Friday. That sounds like a lot until you put it in context. Global copper consumption runs at approximately 26 million tons per year. That means the LME has 1.2 days of global supply. 1.2 days. That is not an inventory. That is a rounding error. The Shanghai Futures Exchange is worse. They are sitting at 56,200 tons. COMEX in New York has 30,100 tons. Add them all together and you get 181,150 tons across all 3 major exchanges. That is 2.5 days of global consumption. 2.5 days. That is the lowest level since 2008. That is pre-financial crisis territory, and we are hitting it while global demand is accelerating, not declining. Now here's where it gets interesting. Copper is not like gold. You cannot just reduce consumption when the price goes up. Gold is a monetary metal. If it gets expensive, you buy less jewelry. You hold off on that investment. Demand is elastic. Copper is different. Copper is in the wiring of every building. It is in every electric vehicle. It is in every data center. It is in power grids, in telecommunications infrastructure, in renewable energy systems. You cannot substitute it. You cannot postpone it. If you are building a hospital, you need copper. If you are manufacturing EVs, you need copper. If you are connecting a solar farm to the grid, you need copper. Demand is inelastic, and supply is constrained. That is the recipe for a price explosion. Now let me tell you what Wall Street has been doing while retail investors were distracted. Look at the 13F filings from Q4 2025. Bridgewater increased their position in Freeport mcmoran by 340%. BlackRock added 89 million shares of Southern Copper. Renaissance Technologies, the quant fund that never talks about what they're doing, opened a $470 million position in copper futures. These are not small bets. These are not portfolio diversification moves. This is strategic accumulation. This is smart money positioning for something big, and they are not buying copper because they think it might go up 10%. They are buying because they have access to data you do not see. They have analysts modeling supply chains, they have contacts inside mining companies, they have geopolitical intelligence networks, and all of that intelligence is telling them the same thing. Copper is about to gap higher, and most people will not see it coming until it is too late. Here is what they know that you do not. The global copper deficit is widening. In 2024, the world consumed 340,000 tons more copper than it produced. In 2025, that deficit hit 580,000 tons. And in 2026, analysts are projecting a 9 to 20,000 ton shortfall. Where is that copper going to come from? It is not. New mines take 10 to 15 years to develop. Existing mines are depleting. Ore grades are falling. The easy copper has been mined. What is left is deeper, lower quality, more expensive to extract. Meanwhile, demand is accelerating. The global EV fleet is expanding. AI data centers are proliferating. The energy transition requires copper at a scale we have never seen before. A single wind turbine uses 4.7 tons of copper. An EV uses 83 kilograms. A solar farm uses 5.5 tons per megawatt of capacity. Multiply that by the infrastructure being built globally, and you are looking at demand growth that far exceeds anything supply can deliver. And Wall Street knows it. Now let me tell you what China is doing, because this is the part that should terrify you if you are not already positioned. China consumes 55% of global copper production. 55%. They are the single largest buyer in the world, and for the last 4 months they have been importing copper at record levels. In December alone, China imported 587,000 tons of refined copper. That is the highest monthly import on record. January data is not fully published yet, but preliminary numbers show another 520,000 tons. Why are they buying so aggressively? Because they are building. They are expanding their power grid to handle renewable energy. They are manufacturing EVs at a scale that dwarfs the rest of the world combined. They are deploying 5G infrastructure. They are stockpiling strategic reserves. And here's the critical part. China is not just buying copper. They are locking in supply. They are signing long-term contracts with mining companies in Chile, in Peru, in the Democratic Republic of Congo. They are securing offtake agreements that guarantee them metal before it even comes out of the ground. What does that mean for everyone else? It means less copper available on the open market. It means higher prices. It means if you are a Western manufacturer trying to source copper in 6 months, you might not be able to find it at any price. This is strategic resource competition, and China is winning. Let me tell you the 3 things Wall Street knows but will never say out loud. First, the copper market is smaller than you think. The entire global copper market is worth about $250 billion per year. That is tiny. Apple's market cap is $3.2 trillion. The copper market is 8% of one company's valuation. That means it does not take much capital to move the price violently. If sovereign wealth funds, if pension funds, if institutional investors decide copper is a strategic asset, they can corner the market. They can push the price to $7 to $8 to $10 per pound. And there is nothing the spot market can do to stop them because there is no metal available to sell. Second, there is no strategic reserve. Governments do not stockpile copper like they stockpile oil. There is no strategic copper reserve you can release to stabilize prices. If the market goes into shortage, there is no government backstop. The price just runs until demand destruction occurs. And demand destruction in copper means factories shut down. It means construction projects halt. It means the energy transition stalls. Governments will do anything to avoid that, which means they will pay any price to secure supply. Third, the futures market is a trap. The open interest on COMEX copper futures represents 1.6 million tons of copper, but COMEX warehouses only hold 38,100 tons. That is 42 paper claims for every ounce of physical copper. Sound familiar? It should. It is the same fractional reserve system we see in silver, and when too many people stand for delivery at the same time, the exchange cannot deliver. They will cash settle. They will declare force majeure. They will change the rules. If you want copper exposure, you do not want paper contracts. You want physical exposure through mining equities or through physical metal if you can actually take delivery. So what does this mean for you? What should you do with this information right now? If you own copper mining stocks, hold them. Do not sell into this rally. The fundamentals are only getting stronger. The deficit is widening. The price is going higher. Companies like Freeport McMoran, Southern Copper, and Tofagasta, these are cash flow machines at 5.40 copper. At $6 or $7, they print money. If you own copper futures, decide right now whether you are trading or investing. If you are trading, take profits when you hit targets. But if you are trying to gain strategic exposure, close the futures and buy mining stocks. You do not want to be holding COMEX contracts when the exchange runs out of metal. If you do not own any copper exposure, ask yourself, do I believe in the electrification of everything? Do I believe AI data centers are going to keep expanding? Do I believe the energy transition is real? If yes, then you need copper exposure. Not tomorrow, not next month, now. Because when the price gaps to $6 and the mining stocks double, you will wish you had acted today. This is not financial advice. I am not telling you what to do with your money, but I am telling you what the data shows. And the data shows a market heading into deficit, inventories at crisis levels, and Wall Street quietly positioning for a massive move higher. Let me tell you what I think happens next. Short term, the next 4 to 6 weeks, we are going to see volatility. The market will test resistance at 550. There will be profit taking. There will be headlines about demand concerns, the usual noise, but the physical market is not going to crack. The backwardation is going to persist. The inventories are going to keep falling, and at some point, probably within 60 days, something is going to break. It might be a major manufacturer publicly stating they cannot source enough copper. It might be a mine going offline due to strikes or technical issues. It might be China announcing further import restrictions on scrap copper. Whatever it is, it will be a catalyst. And when that catalyst hits, the price is going to gap. We are talking 540 to 620 in a matter of days. The mining stocks are going to explode 30%, 40%, 50% as the market reprices the entire sector. After that, there is no ceiling. If the deficit continues to widen, if demand stays strong, if supply does not materialize, copper could hit $7 by year end. Some analysts are calling for $8 by 2027. I think those numbers are conservative if we enter true shortage conditions. Here is my final message to you. The copper market is flashing red warning signals that Wall Street sees but will not talk about publicly. Inventories at 2.5 days of supply, violent backwardation, record Chinese imports, institutional accumulation, a widening deficit with no new supply coming online. This is not a maybe. This is not a possibility. This is happening right now while you are watching this video, while you are deciding whether to act or wait for more confirmation. Do not wait for CNBC to tell you copper is in shortage after the price has already doubled. Do not wait for your financial advisor to recommend copper miners after they have already run 80%. By then, you have missed it. This is Price Discovery Desk. It is February 2nd, 2026. Copper just broke $5.40. The deficit is widening. Wall Street is accumulating, and the smart money is already positioned. If you are not in copper yet, get in now. Mining stocks, physical exposure, whatever gives you access to the move. The explosion is coming. The only question is whether you will be positioned for it or watching from the sidelines. This is Price Discovery Desk. Like, subscribe, and share this with anyone still sleeping on the copper story. The secrets are out. The squeeze is building, and time is running out. Do it now. Go.